Hello class, now we are going to talk about the 4 different types of adjusting entries. So this video is a little bit longer because we're going to cover all 4 types at one time. The 4 types are prepaid expenses, unearned revenue, accrued expenses, and accrued revenue. So a prepaid expense, this is where prepaid, so you think, okay, we paid it ahead of time. We paid it before we incurred the expense. Sometimes it's called a deferred expense because we paid it now, but we put off or we deferred the expense. An example of prepaid expense is prepaid insurance, prepaid rent. Supplies are also a prepaid expense. So when we record them, we want to use T accounts to see the flow of dollars and cents. So we started out with, we received cash and we had a prepaid expense. The prepaid expense is the asset. As we record the expense over time, we're going to reduce the asset or reduce the prepaid expense and increase the expense. So every adjusting entry in this case is going to record an expense and reduce the asset. Let's look at an example. So on December 1st, 2017, Fast Forward paid $2,400 to cover insurance for 24 months that began on December 1st of 2017. So we wrote a check for $2,400 and that covered insurance for 24 months. So if we wrote a check for $2,400 and it covers 24 months of insurance, that means that every month we use up $100 worth of insurance. So we're going to begin by recognizing our prepaid insurance. We would have reduced cash with a credit and debited prepaid insurance. So that's our prepaid insurance account. Then what happens is every month we incur $100 worth of insurance expense. So every month we're going to record insurance expense with a debit because we're increasing an expense, and we're going to credit prepaid insurance. So now, after this journal entry, the first month, we have insurance expense on our income statement, and we have a total of $2,300 of prepaid insurance on our balance sheet. We're going to make this entry every month for 24 months. And every month our income statement will show a $100 insurance expense. And every month the balance in our prepaid insurance will go down another $100. So after 1 month, the balance is $2,300. What will the balance be after 2 months? $2,200. The journal entry is going to look like this. We're going to debit insurance expense, and we're going to credit the prepaid insurance to reduce it. By the way, the T account up there is wrong. That should be a credit, and it's a debit. Look at the journal entry. Another example of a deferred expense or a prepaid expense is supplies. So there's 2 ways that you're asked about supplies expense. One is that you're told, this is what we started with, this is what we ended with, so how much is the expense? Other times you're just told the expense was X number of dollars. You don't have to figure it out. In this case, we know that Fast Forward purchased $9,720 worth of supplies during December. So during December, we would have reduced cash and debited supplies for $9,720. At the end of December, we counted the supplies, and what we found was that there's a balance of $8,670 right here, $8,670. So we have to work backwards, because what we knew was that there is a balance of 8,670. We started with 9,720. So we started with this, we counted and got this. We use those two numbers to figure out how did you go from 9,720 to 8,670. We have to credit $1,050. So what is that $1,050 represent? It represents supplies that we used. So we have $1,050 of supplies expense, and we're going to reduce supplies $1,050. So when we're done with this, on our balance sheet, we're going to have a balance of 8,670 in supplies. On our income statement, we're going to have supplies expense of 1,050. Our journal entry will look like the, wow. Okay, this is wrong. This is wrong. Supplies expense would be debited and supplies would be credited. Wow, this publisher, I need to go through and revise the publisher slides. Really apologize. So supplies expense should be the debit. When we increase an expense, we debit it. When we decrease an asset, we credit it. So you want to debit supplies expense and credit supplies. All right, totally brand new topic. The previous topic we've talked about before. This is a totally brand new topic. So you know how when we buy an asset like plant, property, or equipment, a building, land, vehicles, machinery, we record it on the balance sheet at the cost that we paid for it. But you also know that 10 years down the road, it's not worth exactly what you paid for it. But it's still on our balance sheet at that cost. The problem is that we need to match the revenue that that asset earns against the expense of that asset. We need to match the revenue that the asset earns for us with the expense of the asset, because remember the matching principle where we have to put revenue and expense in the same period. We do this with depreciation. Now, I want to be very, very careful here. Depreciation does not represent a decline in value. In accounting, the sole purpose of depreciation is to match revenues and expenses. There's several ways of calculating depreciation expense. The most common is the straight line method. Later in the course, we're going to look at another two methods, but right now we're just going to look at the straight line method. We take the cost of the asset minus its salvage value. Its salvage value would be set by management and is often, like if you had a piece of machinery and you were going to use it for 20 years, and then you thought it would be worth $2,000, the salvage value would be $2,000. So we take our asset cost and subtract the salvage value, and we then divide it by the useful life of the asset. The idea behind the useful life of an asset is that the useful life is the number of years that that asset will earn revenue for us. But the useful life is an estimate, and in reality, everybody uses the IRS tables. The IRS has exhaustive tables for lives. But when I say it's an estimate, it's like the desk there. The life of a desk for depreciation purposes is 7 years. So at the end of 7 years, you're not recording any more depreciation expense. But that doesn't mean that you're not using the desk anymore, or that the desk isn't useful anymore. So it's an estimate. Just said this. And I told you what the salvage value is too. It's also called scrap value or residual value sometimes. All right. Here's an example, and you're going to learn two new account names. Fast Forward purchased equipment on December 1st for $26,000. So we know that the cost is $26,000. So we recorded it on our balance sheet at $26,000. It has an estimated useful life of 60 months. The equipment is expected to be worth $8,000 at the end of 5 years. $8,000 is the salvage value. That's our salvage. And a year has gone by. They bought it on December 1st. Oh, sorry, a month has gone by. They bought it on December 1st, and it's now December 31st. You have to pay particular attention to the time period on these questions. So the first thing we're going to do is we're going to calculate depreciation expense. So if we take the $26,000 and we subtract the $8,000, what we have is $18,000. So that's what's going to go on the top of our equation, the cost minus the salvage value. We're going to divide that by 60 months because that's how long the asset's life is. So our 26,000 minus 8,000 gives us the 18,000. The 18,000 divided by 60 months is $300. This means that every month we're going to record $300 worth of depreciation. Every month we're going to record $300 of depreciation. Here's how we're going to do that. These are our new accounts. Depreciation expense is our expense account. Now, it's kind of a funny expense account because it's a real expense, but we don't pay any cash for it. We never write a check for depreciation expense. It's all a book expense. Depreciation expense, and the other account is accumulated depreciation. Accumulated depreciation is a new account for you. It's also a new type of account. Accumulated depreciation is what is called a contra asset. Contra asset. And what that means is that it's a special type of asset that has the opposite normal balance. So if an asset is normally increased with a debit, a contra asset is increased with a credit. And we're going to use accumulated depreciation to reduce the book value of the asset. This is what our journal entry is going to look like. We're going to debit depreciation expense and we're going to credit accumulated depreciation. When we've done this, on our income statement, we have depreciation expense. On our balance sheet, we have accumulated depreciation that reduces the value of the equipment. This is what the balance sheet looks like. So here's the equipment, less accumulated depreciation gives us the book value of $25,100. Now, I want to point out what book value means. The only thing that book value means is that it's the net value on our books. That's all it means. It has nothing at all to do with the market value of that asset right now. It's only called book value because it's the net value on our books. So every month we're going to do $300 more of accumulated depreciation, and every month the net book value will go down an additional $300. So right now this is after 3 months, 3, 6, 9. All right, second type, unearned revenue. Unearned revenue or deferred revenue means that we put off recording the revenue or earning it, but we've already received the cash. We have the cash, but we deferred the revenue. Unearned revenue. Unearned revenue happens commonly when we receive a prepayment for a product or service. Like when I made cushions, when our company made cushions for Hilton, they would write us a $20,000 check in advance and for like half down, and then at the end of the job they would pay us the other $20,000. But the $20,000 that they wrote us at the beginning of the job, we hadn't earned that. We earned that by manufacturing the cushions. So we would have recorded unearned revenue. Unearned revenue is a liability. It's a liability because we owe something. We either owe performance of the service, like making the cushions, or they're going to want their money back. Unearned revenue, liability. So here's an example. Let's say that Fast Forward's client paid 60-day fee in advance, covering the period from 12/27 to 2/24. When they paid the $60 fee, the 60-day fee in advance, we recorded cash and unearned consulting revenue. I'm actually going to pause because my headset is running out of battery. I'm going to post this, and then tomorrow I'm going to pick up with another video starting with unearned revenue.